Hello, I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, sponsored by Börse Stuttgart Digital, on how to build a cryptocurrency trading, investing, and custody infrastructure for your clients. At the heart of our somewhat ingenuous title lies a single subject. Cryptocurrencies are now part of the institutional as well as the retail trading and investment mainstream. The question is not whether banks, private banks, asset managers, wealth managers, exchanges, brokers, financial market infrastructures should offer cryptocurrency services to their customers. It's whether they should build those services in-house via a platform from a vendor or outsource the service to an established provider. To help us understand these choices, we're joined by four experts, each of which has direct experience of this very question. Andreas Sack is head of digital assets infrastructure at Deka Bank in Frankfurt, where he is responsible for leading the development of regulatorily compliant cryptocurrency trading and custody services that can be integrated with the other services of the bank. Francisco Maroto is head of blockchain and digital assets at BBVA, where he leads blockchain, cryptocurrency, and digital asset strategy for the bank. Stephanie Harry is Global Head of Business Development and Partnerships at Börse Stuttgart Digital, where she works with clients to design and implement a cryptocurrency trading, investing, and custody infrastructure that works for banks and brokers. Our fourth panelist, who will be joining us shortly, I hope he's delayed somewhat, is Carlos Martin Doncel, who is Digital Assets and New Initiatives Lead at online trading and banking house Swissquote, whose proprietary SQX exchange for trading cryptocurrency was launched 4 years ago in 2022. As always with a Future of Finance webinar, we encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of the Zoom screen. Again, as always, we won't be saving those questions and comments up to the end, but we will endeavour to answer them as we go along. So, as members of the audience, you can be an integral part of this discussion right from the outset. Indeed, in a sense, you have already been part of the discussion. All registrants for our webinar today completed a set of 5 multiple choice questions, and we're going to share those answers with you during the course of this webinar to inform and to some extent structure our discussion. In fact, I'd like to begin by sharing with you the answer that you gave to our first question. Essentially, what are you doing in the cryptocurrency markets today? Could we have the first slide, please?
It's coming, hold on.
Carlos, you've joined us. How nice to see you. I hope you heard my introduction.
No, I just missed it, but thank you. Either way, I'm here now.
Okay, that's very good to see you. We're about to look at a slide to kick our discussion off, so you haven't missed anything important at all. Now, as you can see by looking at the red bar, only a minority of our audience today are doing no trading or investment in cryptocurrencies whatsoever. That's because almost all of them are not bankers or brokers or asset managers, but they're advisors, lawyers, consultants. Of the remainder, 60% of you, that's the 3 dark blue bars, are active in cryptocurrencies on your own account or on behalf of your clients or both of those things. And the remaining 40%, that is the 3 green bars, are planning to be active in cryptocurrencies, either on their own behalf or on behalf of clients or both of those things. So there's clearly a great deal of interest in cryptocurrencies. Now, if we look at the second slide, that will give us an idea of the client base of the audience for our webinar today. We asked all of you what types of customers you're serving or expecting to serve. As you can see here, we got a pretty clear answer to that. 80% of you, as respondents to our poll, active in cryptocurrency markets, are aiming your services at institutional clients. Our third slide will give us an idea of how you're giving those clients access to cryptocurrencies. The most popular choice, and I think we'd expect this of institutional money, is to use regulated exchanges. That's measured in that tall red bar. If you look at the smaller red bar, some of you are also using unregulated exchanges, which was possibly less predictable. The second most popular choice is to go to market via brokers, both prime brokers and agency brokers. That's the two green bars. Only minorities of you are using proxies such as Bitcoin futures and options, Bitcoin funds, or corporate treasuries, such as Strategy. So again, there's clearly rising institutional interest in cryptocurrencies, and it's expressing itself using a variety of tools, but mainly exchanges and brokers. And so, Stephanie, perhaps we could start with you. What is driving this clearly rising institutional interest in cryptocurrency investment and trading? And how are banks and others who are looking to support their clients behaving in terms of building out the trading and operational infrastructure they need to support those clients?
Thanks, Dominic. I mean, I think that it's primarily a defensive move, to be honest with you. So I think particularly banks or brokers that service a retail client base are seeing neobanks increasingly take their clients. And then with MiCAR, you are having more actually traditional banks also come into this market. So primarily, we see banks wanting to make sure that they service a need when it arises to avoid the situation where a client has to onboard with a third party, because we see increasingly the gap between traditional players and actually crypto native companies starting to close. And these crypto players potentially can offer other services to your clients, right? So, for example, trading equities or ETFs, etc. So the banks kind of come in to protect the client base. And of course, there is also a financial incentive in that the crypto trading is still fairly popular and a high margin activity.
Mm-hmm. Thanks, Stephanie. Andreas, now you're, as I explained at the outset, head of digital assets infrastructure at a bank. Does Deca Bank, as a bank, see cryptocurrencies as opposed to digital assets more broadly as an integral part of a single strategy, a single digital asset strategy, or are cryptocurrencies a sort of standalone proposition in the bank?
Therefore, I have the first is a short answer, yes. And if I look on my roadmap and into the history, I think it starts with the client demand for us. We started our institutional business, for example, and with crypto custody and brokerage in 2024. And looking on our strategy in the future, we expand the focus now within the next months. Our offering for retail customers for the German savings banks group will go live within the second half of the year, and I see it is a completely it's completely integrated in the asset strategy, because the cryptocurrency is not it is more mature, it is more institutionalized in the future, and due to the listed crypto ETPs, ETFs, and so on, more and more institutional clients see this asset class as an attractive asset class.
Francisco, you're head of blockchain digital assets at BBVA. What do you think is actually going on here? Are banks embracing cryptocurrencies because their customers are, or are customers embracing cryptocurrencies because banks are? I mean, maybe both of those things are true, but how would you characterize this clear rise in institutional interest in cryptocurrencies?
I would say both, but mainly institutional interest is coming thanks to regulation. So regulation has been a catalyst. It's MiCA in Europe, the News Act in the US, very clearly pushing forward different banks and financial institutions to access these new markets. And this is driving broader adoption. No? When traditional FIs offer this type of services, we see the customers following, no? At least the customers that were not willing to operate with crypto exchanges or with fintechs, they can now access through these traditional FIs and the indirect exposure to crypto through the products you mentioned, ETFs or others. No, regarding the strategy, I partially agree that it's partly could be seen as a defensive move, but that's not the strategy of BBVA. In BBVA, we think it's crypto is only part of the broader digital asset strategy. So we started working with blockchain technology 8 years or 9 years ago. We soon realized that blockchain could be a new way to exchange value in the digital economy, and that the digital economy could be based in tokens in the future. So what we decided is to prepare the bank to be able to operate with these new tokens, and to be able to give access to our customers to this new digital tokenized economy. And within this vision, we had to prepare the bank to be able to custody these tokens, to move or buy, sell these tokens, trading, and to be able to issue these tokens. And when I say these tokens, is these digital assets broadly. One part of digital assets is crypto, which is fine, and there's volumes in that market. That's why we are active in the market already. But we are now strongly investing in tokenized money in different forms, stablecoins and deposit tokens. And we also see that the third wave, or the next wave of digital assets, could be tokenized assets. And that's also part of this broad strategy that covers these three big items or topics. And crypto for us is one of them. We've been offering crypto services to our customers in Switzerland for 6 years now, in Turkey for 2 years already, and now in Spain since last year. And hopefully we will be able to give access to the rest of the customer base in the different countries of the footprint as soon as regulation allows us to do so in Latin America. But the vision is not giving access to crypto. Crypto is one of the different assets that will come in the future in tokenized format. So we are trying to give access to our customers to crypto, tokenized money in the different forms, and tokenized assets in the different forms. So that's a bit the vision and the strategy.
Yeah. So crypto, digital assets, digital money, all part of a single corporate strategy. Carlos, Francisco made an important observation that one of the explanations of rising institutional interest in cryptocurrency is that the regulation of the asset class has become clearer, so the compliance risk of getting involved has gone down. Now, Swissquote has obviously been committed to cryptocurrencies since long before that regulatory safety net was built. You know, you're obviously strategically committed to cryptocurrencies, but as you're both a trading house and a banking house, you have I think a more interesting, or at least a dual perspective on the question of strategy. And Francisco's talked about, in effect, digital money, digital assets, and cryptocurrencies being part of a single spectrum of tokenized assets, if you like. But is there something to be said about strategic synergies between, if you like, the banking side of this and the trading side of this? And Swissquote is in a good position to give us a view on that.
Mm-hmm. So for us, a bit of the same. So we started only with the concept of crypto since 2017. So either my old title, by the way, was crypto only on that sense. That evolved towards digital assets. So we also make this differentiation that Francisco do at BBVA, but also Andreas and Stephanie. So we have this same umbrella term that is digital assets. If you want to be more pedant, you can say, DLT technologies behind the scenes, all right? Whatever you do with it. One of them, and the biggest market as of today, has been historically cryptocurrencies, which is where we will include now Bitcoin and the rest. As a trading house for us, the most important USP for Swissquote, both locally and internationally, is we have everything the client wants to invest into. So from that premise, cryptocurrencies were a natural step for us because clients were extremely interested in the asset class, but the lack of regulation at the beginning was a bit of a difficulty, although for us, more than regulation, it was a technical difficulties in all the senses, as I've said in previous events. But from there now, we are more, because our core business is not necessarily the issuance, but the access. We're putting the infrastructure ready for this issuance momentum that we're waiting for. But for the moment, playing a more passive role in that sense, is giving access to the investments. Also, more than looking, for example, into the MMF world or others, let's say more the largest markets that you can find today in tokenization. For us, digital assets are maybe more interesting with new products behind the scenes, right? So having, for example, here I'm talking about expensive products to distribute or that are extremely painful, like private equity. this is something we're looking into because it's where we see an immediate effect. For the rest, I mean, it really depends. We don't have a global systemic banking group behind, as, for example, Francisco has. We don't have an insurance business as Stephanie. So for us, we're a bit more in the middle. Cryptocurrencies were more obvious than digital assets are now for us. So it's a bit of a different position. Yeah.
Okay. Thank you, Carlos. Before we move on to discussing the process of actually making the right choice of how you build the infrastructure to support your institutional clients, well, we've established that there is growing interest. I just remind everyone listening that we do welcome your questions and your comments. Just use the chat function at the bottom of the Zoom screen to ask any questions or make any observations to our panelists, and I will put them to the panelists as soon as I possibly can. Anyway, here we are. We've established there's rising institutional interest. You're a bank, you're a broker, you might even be an asset manager, you might be a market infrastructure, but you've decided to support your institutional client base with their activities in the cryptocurrency markets. What do you need to provide those clients with? Now, Andreas, perhaps I could put this question to you first. What is the minimum product set that a regulated institution getting involved in crypto is going to need in terms of products and services that they must provide to support their own clients?
Yes, thank you for the question. First of all, I think every company defines that for itself. For us, for example, I decided to start with crypto custody. That was our starting point because we do not want to hand our clients or clients' assets to a third party. That was the main reason why to start with crypto custody, and I think starting with crypto custody was potentially the longest way to step or to go into the crypto market or digital asset market. If you do not want to do it by your own, you will be a little bit earlier. Maybe then you have a third party in charge, but that was our minimum product. And from now on, I think the development regarding crypto services, if I look on the asset type, it doesn't really differ between the other companies. You have cryptocurrencies in charge. Later, then you have stablecoins in charge, and after that, you will have tokenized assets. That is my roadmap at the moment. And I do not think that we miss a market, for example, if we do not have digital assets as tokenized assets now in charge, because I do not see the market. Maybe that's only a regional view, but I do not see the real demand now. If I look in the future, I can think about potential value-added services, but that could be staking, for example, as an additional service. But now we have to do enough with our cryptocurrency trading and our own custody services. And looking in the second half of this year, I look forward that we start on a private blockchain called Regulated Layer 1 with asset settlement of tokenized assets.
I know, Dominic, you said feel free to jump in. So
Yeah,
I thought what Andreas was saying there, it's, I think, both highly relevant, but also something we hear a lot in the market. I think that owning the client interface is really critical. And I thought a lot about this question prior to the webinar. I think, you need to own the client yourself, you need your own licenses, and you need to own the client interface. But where I would maybe differ from Andreas is where for a bank like Deca that, services the Sparkassen in Germany, you have a slightly different model where you are an infrastructure player to some extent. So then owning the infrastructure for custody would absolutely make sense, but I don't think that it makes sense for every bank. So I think that If you're a custody bank by DNA, if it's a core capability, then that's something you build yourself. Increasingly, you do have options in terms of sub-custodians and brokers that are regulated under MiCAR. And then if your step one is monetizing the demand from cryptocurrencies, then that is a faster, potentially easier way to go. And then we come into this conversation of, okay, well, what is like the long-term plan? For example, as Francisco said, for BBVA, it's really this a broader digital asset journey. Then you need to start bringing things in-house so that you can build up your stablecoin capabilities, your tokenized asset capabilities. But if you just have a 1 to 2 year roadmap on monetizing crypto, as long you can own the client and still use a service provider to do the rest.
Yeah, if I may jump as well to continue the conversation, I totally agree with Stephanie. It's a matter of I would say counterparty risk and flexibility or freedom of development of what you want to do. If you have it in house, you can do what you can put in your custody the token that you wish to work with. If you are depending on a sub-custodian, you need to convince that sub-custodian to bring in the token or that specific service for you. So that's one of the things to take into account. The other one is the counterparty risk. When we started this journey, we were thinking about a white label solution, so working with a third party. But 7-8 years ago, when we started, there were no TradFi institutions like Stuttgart Börse that could offer the service to us. So the counterparty that we had at that point were fintechs and young startups. So we couldn't rely on them. And at that point, we also saw FTX collapse and all the crisis that came with it. And we thought that it was very risky to rely on a third party. So that's why we started building in-house. Right now, there's a different market and different situation. We have established players like Stuttgart Börse and others that offer crypto custody or digital asset custody. So maybe that's something to take into account if you don't need that flexibility or that freedom. No? The advantage of working with these white label solutions is the speed, the time to market, as Stephanie was saying. No?
Okay, it's interesting what you're saying about the long and the short term roadmap, and we'll come on to this a bit later in the webinar because our audience have given us one of their key buying criteria on the trading side is future proofing any service they buy. In other words, that they can extend the service long term into various new classes of digital asset, starting with stable coins, but obviously including tokenized securities and stuff later on. Anyway, we've had our first question from a member of the audience. It's from Michael Smith, and he asks, in the equities world, ATS have grown enormously over the last 15 years. Do the banks here anticipate that they will operate their own trading and custody operations in competition with the more established exchanges, by which he means the likes of Binance? Which one of our bankers wants to address that first? Andreas, can you give us a view on that? Are you going to start competing with Binance?
I'm not sure if I see Binance as a competitor for us.
Coinbase, maybe a more respectable one.
Yeah. First of all, I'd like to add the point that's I think we have a good point, and it's fundamental for us to have a good regulated and compliant infrastructure in charge, and also working together with the MiCAR licenses, for example. To be honest, they start on a completely green field without any legacy systems, legacy structures in the back end, and so on. I think there is a long way, and I think if I compare a typical client from our clients, for example, with and I do not know the typical Binance client, but I think they are not the same. And I do not think that it's a clear competitor, for example. We as a bank have a lot of other products in charge, what are not in the product portfolio of a not a traditional, but of a typical cryptocurrency brokerage service provider, for example.
Francisco, do you want to make a quick observation on that?
Yes.
Whether what you're doing evolves into a kind of digital asset exchange that competes with the...
Well, I agree with Andrea. We are not certainly the same type of institutions, but we are competing in a specific space. So depending on the geography and the region, could be differences as well. It's not the same Europe as Turkey, for example. But I think that at least we are competing for the money of the customers that they have or they want to invest. No? Traditional, or before the existence of crypto, investors could invest in the different, fixed income or stocks or whatever funds, whatever we could offer them. Now we have a new asset class, and we have new players offering this asset class. So our customers might be interested in investing part of their money in this type of assets through crypto exchanges. So in that sense, we are competing with them for that specific part of their money they want to invest in crypto. And that's why we want to offer crypto as well, so that our customers don't need to onboard Coinbase or don't need to onboard Binance if they want to buy Bitcoin. They can do it with us. No? That's a bit our thinking, to be able to offer all the assets to them. If you want to invest in the long tail of crypto assets, you need to go to Coinbase or Binance. I think that traditional financial institutions as banks, we will have it very difficult to offer all the broad spectrum of crypto because there are very shady tokens in the space that we would never list in our offering. No, so there's some difference in the offering, some difference on the ways that we offer the service, but the part of the money that the customers that we are trying to compete for, I think we are competing for that part. And depending on the region, we have different approaches. For example, here in Europe, we go for a more simple service that tries to complement traditional financial assets with access to a few cryptos. In the case of Turkey, where we have a strong presence as well, we are competing directly with crypto exchanges. So we are offering more than 30 tokens already, and we want to compete face-to-face with them. So because in Turkey, there is a huge adoption of crypto and a mass demand, and we want to compete face-to-face with them with the same kind of offering and services. In the case of Europe, it's not the same, so we have a different strategy. So depending on the market, you can address different strategies.
Okay, so just to be clear about that, a point that Stephanie raised, owning the client interface seems the obvious answer to this question. We will give you access to Coinbase and Binance and anything else you might want to reach, but actually there are certain market segments where we might actually want to start competing with the established providers, particularly as digital assets grow into new asset classes. So, Michael, I hope that answers your question. I thought we could now just move on to the substance of today's webinar, which is institutions that want to service their clients in the cryptocurrency markets. They, as I said right at the beginning, I think basically have a choice of three. They can build the infrastructure in-house, they can buy it from a vendor, or they can outsource it to an established cryptocurrency service provider or infrastructure. Now, we did ask you, our audience, what choices you've made, and slide 4, if we could show that now, shows what choices people made. Now, of our respondents who are actually offering cryptocurrency services already, half of them built their cryptocurrency platform in-house. A quarter of them have spatchcocked together some combination of in-house technology, vendor technology, and third-party service provision. A fifth or so rely on a custodian bank, and I assume this is the digital asset platforms offered by custodian banks, which offer a kind of integration with traditional securities and payment services. I was interested, only 5% of our audience or so brought a cryptocurrency platform from a technology vendor. So the big message here is a lot of people are doing this in-house. And Andreas, perhaps I could throw this question at you first. How would you how do you make this choice between building something in-house, outsourcing it, or buying something from a vendor?
I think now it's around 5 years ago as we decided, and we make a contest between different potential solutions, and we come from the operational resilience side and look how it's possible to reduce reliance, how to mitigate, for example, concentration risks and so on. And our solution finally was to develop it in-house. Clearly, what was clear for us was we do not build our own key management software by our own, because we know what we are. We are a bank, and we are not a software provider or a software developer. But we build up a complete on-premise solution within our own data centers. And for example, that's very special. Our data centers are completely in Germany. And we come from the compliance side, we come from the risk mitigation side, and we want to reduce as much as possible third-party risks. And looking on it today, I think it was the right solution in combination with HSM modules. I think it was the most secure solution we can choose, and we will develop it within the next years in stages. And from now on, I think it was the right solution to use it or to implement it in our own infrastructure with our own IT dev team. How build the integration layer to our legacy systems, and to have the complete infrastructure for our clients in our own infrastructure.
Thank you, Andreas. So,
Yeah.
Francisco, you've heard Andreas. He went in-house, he integrated it with what was there already. You may have something to add on that, but I'm also wondering to what extent, as a regulated bank, you're actually constrained in what you can do. By which I mean things like, as a regulated bank, you can only deal with other regulated counterparties without running undue compliance risks.
Yeah, so I mean that's key. We are supervised, so we need to comply with things like DORA regulation, and that constrains a lot the spectrum of partners or companies that you can work with, no? And we are as well under MiCAR, so we can only work with MiCAR regulated institutions as well. I am talking about liquidity providers, for example, no? That they need to be as well MiCAR compliant. If we decide to do sub-custody or work with another party doing custody in Europe, again, it has to be MiCAR compliant, has to be DORA compliant, and and all the other regulations that apply to banks that can limit a lot the spectrum of potential partners that you might have in the ecosystem. No, so yeah, totally. I mean, and then once you have these partners, again, you have to share the contracts with these partners with the central bank, because the central bank as well has to review these contracts and analyze the risk and understand that you don't have relevant third-party risk. No? So yes, very, very supervised, and everything you do and every counterparty you have needs to be as compliant as you, and needs to go through the approval of the supervisors. No?
Carlos, I think I'm right to say that you have a retail client base as well as an institutional client base. Now, retail for many of the people on this webinar will mean not B2C, but B2B to C, I guess, which means that the needs of institutional and retail clients will differ. And I guess you'll have in-house clients as well, proprietary business, their needs are going to differ as well. How difficult is it for a service provider to distinguish between the needs of these different underlying client groups? Do you have any thoughts on that, Carlos?
Well, there's different degrees, right? the good thing is the discussion between Andreas and Francisco was showing something important, and it's when regulation comes in, there's a certain degree of, let's say, differentiation factors. Okay, once you have MiCA into Europe, what's the technical key difference between custodians, for example? For me, it's sort of commoditized a little bit. The brand starts to play a huge role. And it's funny because we've been since so early, and cryptocurrencies, decentralized, non-centralized exchange, centralized exchanges, the brand was the key factor. Then you have a technological issue or a catastrophic event, and then, that's how the cycles were built. Now I feel the same. It's commoditized. For, let's say, a bank that starts right now to look into crypto, what is the key difference between LPs, sub-custodians, and custodians? Honestly, it's very difficult. So for us, the two key differentiators is the offering you're bringing and the connectivity, how much your connectivity is, optimized for a certain type of client. Those two are the key factors. What you offer and how do you distribute that offering? For institutionals, as you said, we started with retails. Our retails are a bit special also because a Swiss retail is not a European retail. And that's also a key difference. In Swiss code, a Swiss trader is not the same as a Swiss retail, a non-Swiss retail. Like our average account for a mass retail is 165,000 Swiss francs. So it's a very significant size. So it's different, and the USPs are different. If I want to work with financial institutions inside or outside of Europe, because inside of Europe I can, because we also have a Luxembourgish bank, and the challenges are totally different. It's all about connectivity. Do you use the OEMS? Are you pre-connected to my ITP? These kind of conversations are the more important. They don't care necessarily how you custody the assets. You're regulated in Europe, you're MiCA compliant. Okay, next. You are a bank, better. You have a good reputation and a long-standing record, even better. But at the end of the day, the key factor is I'm using Integral. Are you distributing through Integral? Are you using Lucera? Are you using Talos or Wygen? That's in the end for me, the conversation with the B2B and B2B2C side ends there. That's the key factor. The rest, we're more or less commoditized to a certain degree. Some have some specific USPs, some type of orders are restricted for some providers, not for others. It's on the fine details, but on the general offer, it's fully commoditized because of regulation, of course.
Yeah. And perhaps if I could add to that, because I think we've touched on a lot of very important points, and then also over quite a long time frame, right? Because as Andreas said, when Deca started building the offering, I mean, this was almost 5 years back. I mean, same with BBVA. And in that case, there's no choice but to build it yourself, right? So you're developing the infrastructure, maybe using an infrastructure provider for custody. And then now where Carlos fast forwards us to today is if you started this process already 5 years ago, then you have a multi-provider set up with your own infrastructure, a backup custodian, you connected through an order management system, you have multiple liquidity providers, and you're thinking about staking, you're thinking about integrating other services. And I think that we've missed kind of a gap in the middle where there have been a lot of banks that have been monitoring the market, developing the expertise, but with the mantra, I will not move first, I will be a fast follower. And we talk to a lot of those banks, and they're in this kind of middle ground saying, okay, I actually need to move quite fast now because there are other players in my market that are already offering something, but I'm not quite at the point where I want to build everything myself because maybe I have a different nature of client base. And Carlos touched on that, like a Swiss retail client is not the same as European, but also, if you have a high trading client base and you're a broker or you're the retail part of a broader wholesale bank, you have a completely different mindset than if you're sitting on markets or you're running asset servicing, etc. And these kind of middle ground banks, they do sometimes say, okay, well, nowadays I have an option to use a primary broker with a sub-custodian. So I could go for an integrated offer as phase one. And then they will always kind of negotiate with the provider to have the flexibility in future. So under MiCAR, they need redundancy, they need to ensure best execution. But there is kind of this interim phase where you can move fast to monetize the demand. And then you have that path where you could eventually become a Swiss quote with multiple liquidity providers. But it's, if you think it is, even for the players on this call who are really at the forefront of their field in their various markets, they've taken a long time to develop the solutions. And there is a kind of a shortcut, I would say now, that you can do in the interim and then say, all right, but I have a 3-year plan to in-house on my own, for example.
Okay, could we talk about custody? And there are 2 reasons why I want to do that. One is that we've had a question from a member of the audience about custody, and I'll read that to you. If you're a custody bank and you haven't established a digital custody offering yet, and given there's a number of institutional providers out there, both native and hybrid digital asset custodians, what would persuade you to go it alone over partnering these days? Now, I think that's an interesting question, but if we hark back to the answers we got from the audience, a fifth of them are reliant on a custodian bank to support their cryptocurrency services, not just from a custody perspective, but from a market access, brokerage, compliance, every other sort of perspective. So a thought that occurs to me is our attendee is asking, what strategy should a custodian bank pursue? My answer would be, from what our audience are telling us, is that you've got to offer the whole enchilada. You've got to offer a full set of services, because people want the integrated offering, either in the short term or in the medium term, or perhaps in some cases in the long term. So you've got people buying cryptocurrency services from their custodian who's also supplying the brokerage, which sounds like a quick and practical answer to getting the capability up and running, but it doesn't sound to me like best practice. So I'm kind of asking 2 things here for our attendee. Should a bank that doesn't have a digital asset custody offering start offering that, or does it need to combine it with other things? And secondly, would your advice be to people looking to build this capability to think twice about keeping custody and all the other services, buying custody and all the other services from the same provider? Is an integrated offering less than best practice? Sorry, 2 questions there. Maybe Stephanie, you're best placed to answer those, since you must get asked this quite a lot.
Yeah, I can maybe start, and then the others can feel free to add. I think, should you start with a custody offer? I mean, I have seen actually a couple of banks say, we like the idea of custody, but we don't like the idea of trading because it introduces us to external compliance risk. I don't really like that argument, just from the perspective that the assets have to come from somewhere, right? So if you offer custody, you have to let the assets come into your custody, which means that you either screen them directly from the end client, or you buy them through a broker. And if you use a regulated broker that also is connected to blockchain forensics providers and is doing things properly, that's probably the safer way to get clean crypto into your system, is to offer the trading, allow the clients to bring cash in or fiat in and buy crypto. And if you rely on deposits in, then you still have to have the compliance capability to accept those deposits in. So I would say to do custody on its own, if that's the question, it doesn't necessarily reduce your risk. But very happy to have others jump in. And then you mentioned, do you think twice about having just a single provider or multi-provider? I think that there's pros and cons for both. If you have a single provider, you know where your point of failure is. So if you're doing trading and custody, there is operational risk that within crypto when it comes to transferring assets. And if you're using a single broker and custodian, a lot of that is happening kind of within the same interface. The minute that you start to add order management systems and multi-brokers, then if something goes off, there's kind of more points. But then this legal segregation between the entities that you trade with, especially after FTX does give people comfort, right? And say within Börse Stuttgart, we do have two separate legal entities. We have a broker and a custodian with separate governance structures. And then under German law, of course, your assets are bankruptcy remote. But I think that there is an argument around separating those two functions in terms of the legal structure at very least.
Okay, thanks, Stephanie. I'm conscious we're into our last sort of quarter of the webinar, so I'd like to move on rather than give Francisco and Carlos and Andreas a chance to talk about custody as well. We can possibly come back to that a bit towards the end. Just a quick question to you, Stephanie. How important, because I'm going to now talk about purchasing factors now. Could we just get one out of the way? How important is price in deciding how you're going to set up your cryptocurrency infrastructure to service your clients? I mean, just give a very brief answer. Is it the bottom of the list of 10 factors, or is it near the top somewhere?
No, I think for a lot of the banks that we talk to, they want to avoid upfront costs, and they expect the provider to charge, say, basis points on the trading and custody volume, and that is getting increasingly competitive. But it's about like finding a partner that takes the risk with you into building the solution.
Right. So it's avoiding the big upfront investment cost is the factor. Now, that is one of 29 factors I was able to think of when I sat down to ponder this webinar, and I was then stupid enough to put them all into the registration question and ask the audience to select their top 3. Well, if we could bring the 5th slide up now, you'll get an illustration of how if you ask a stupid question, you get a stupid answer. And a long list like this doesn't really tell us very much, though I would say it's quite interesting that asset safety and compliance were the 2 factors named most often, and we'll come back to that in just a minute. So to make more sense of this long list, I divided the responses to the buying criteria into these 4 main categories: trading priorities, post-trade or operational priorities, compliance priorities, remaining compliant, and the business model, what type of service provider you're transacting with. So let's look at trading priorities first in the 6th slide. And when the 6th slide comes up, we'll see that what matters is pretty predictable. It's liquidity, ability to buy and sell your assets regularly and readily. It's price quality, best execution, an obligation obviously on regulated entities, less moving of the market against yourself, access to as many sources of liquidity as possible, and of course getting on and off chain out of the fiat currency quickly and cheaply. Now, Stephanie, this obviously prompts a whole series of questions about, and by this I mean liquidity, pricing, market access, on and off ramps. These are the top priorities which the audience is naming. Now, I don't know what can providers do to deliver those things, and can you guarantee it in all market conditions? I mean, people obviously also want access to lots of counterparties, lots of brokers, lots of exchanges.
Mm-hmm.
As you can see here, actually going through a prime broker isn't actually that popular an option, though it seems the obvious one. I noticed one respondent added to my list of factors a 30th one about, off-exchange settlement, atomic settlement, capital efficiency, one pool of collateral. So what is your response to these first 4 priorities that have been named: liquidity, price quality, multiple access to multiple counterparties, and that on and off wrapping? I mean, how hard are those things to deliver?
Yeah, I mean, fundamentally, at least within our offer, we are a broker, right? So within Börse Stuttgart, the banks that trade with us trade on a principal basis against our broker, and that broker then offers the 1, 2, 3, and 4 on your list, right? So I think it's not kind of an either or. There's a bit of overlap here, but I think that for banks and Carlos, I think it was Carlos, but also Francisco mentioned it. You need to face a regulated counterparty under MiCAR if you're offering your own services under MiCAR, and it also makes your conversation with the regulator much smoother. So you have kind of this mix where you're looking for principal trading, and then you either need to connect multiple brokers and then create like best execution yourself, or you allow that broker to provide you market access and the type of reporting that you need to meet your best execution requirements or responsibilities to your clients, which is effectively our model. So it's, you face the broker, but behind the broker, there's a merged order book that's then created through the markets that broker then accesses.
But I think it's also an inherent issue of cryptocurrencies, and here specifically cryptocurrencies. It's a super atomized market. Honestly, on the first draft of MiCAR, I was a bit scared because I was saying to myself, there's no way we're going to detach Europe as Korea did it back in the day, as Japan did it back in the day. It was a huge mistake for retails, and both regulators backed off pretty fast, even with two markets that have a huge organic demands. That's also a bit the roles of international market makers, which are a bit on the gray area. They're not necessarily fully regulated, fully supervised type of entities, but they are a necessary devil, as I like to say sometimes, especially, again, in these super atomized markets. But at some point, it's just mandatory to have multiple sources of liquidity. I mean, not only for redundancy, risk, but also for the quality of service. Here, again, we come back to the question of how your clients are sensible to some of the things. My clients, I caught trading for 5 minutes because a third-party provider, imagine it's my only one, is offline for 5 minutes for a very legitimate reason. For that second split, the market goes up 2%. I'm cooked. Why? Because they could find this liquidity elsewhere. It's not like traditional markets. If the NICE goes down, okay, there's no NICE, no parallel NICE. So we are all in the same boat, right? But in crypto, if you are a crypto native in 17, 18, and Coinbase goes down, you have Bitstamp, Binance, Kraken behind. If those two were down, you still have always one at some point that will work, right? So I think that's a key differentiator. But again, a mass retail will not be very sensitive towards this. I think we saw recently some reports. I think it was Revolut, for example. Bitcoin went to 2 cents on the screens for clients, 1 minute. The degree of impact a mass retail client has on this, it's a tweet, a screenshot, funny take, no one loses money, everyone is happy, right? You have this type of dysfunctionment at DekaBank, BBVA, Stuttgart Börse has that, or with us, our clients, they are suing us directly. I mean, it's not even a question of how much time is, how many lawyers are they going to send, right? So I think that's really important. It's not only, about traditional surveys, SLAs, let's say. It's about the fact that liquidity is in many places at the same time. So
good point, Carlos.
I don't know how to say that in English, but the
risks here are novel. We're into our last 10 minutes, so let's have a look at the list of post-trade or operational priorities, which are our slide 7 from our list of purchasing factors. What people look for here, you'll remember that asset safety got the most votes of any factor in my full set of 29 factors. It's number 1 here, closely followed by settlement, which is not surprising, I think, in an industry that's prone to hacks and lost private keys, or has that reputation anyway. And of course, where transfers of assets are the chief point of vulnerability. People clearly want the cryptocurrencies owned by their clients to be kept safe and settled safely too. All the other points here, independent custody, self-custody, insurance cover for assets, I think only really reinforce those priorities, though I was interested by the relative unpopularity of doing custody in-house. Andreas, a question for you. Our poll clearly confirms institutions buying cryptocurrency services want to ensure their underlying clients are going to be not just have their assets kept safe, but probably be made whole if their assets go missing. And what's your advice on the sort of custody arrangements best designed to deliver that insurance? Should people be doing it directly? Should they keep the assets themselves? Should they use an independent third party? What should they do? What's your best advice on achieving those goals?
I think we asked ourselves the same question, because we want a safe infrastructure, and we want safe assets for our clients. I came to the conclusion that the solution, though that the answer lies within your own key management solution, that you have the control on it, and you have to add a lot of different safety lines. That it's not only to build it up in the own infrastructure and an on-premise solution. You have to add multi-factor authentications. You have, if I look back to the last hacks, for example, I look on the underlying infrastructure and I do not see HSM modules there. I see a lot of MPC solutions, for example, and that is always the answer for me, that we choose with the HSM modules as key management hardware or as the key storage. It was the right solution. And what I see, for example, from institutional clients who are at the moment in a self-custody stadium, they want to make transfers to our custodian services. They do not want to be longer responsible by their self-custody. They want to have a secure and MiCAR compliant custodian who make the custody services for them.
Francisco, did you have anything to add on this?
No, not really, not much to add. One topic that I didn't see in the previous slide or this one, which has been really relevant for us at least, is the integration with the provider. So integration, the easiness of the integration, the APIs that they have, the standards that they use, the flexibility to adapt to your needs on your systems. That's a key differentiator, and it's something that we, at least in BBVA, we value a lot, and that eases a lot the integration. No? That's a key aspect as well when you are planning to work with this type of providers. No?
Okay, thanks, Francisco. We're getting very tight on time now, but I'd like to just share with the audience one finding which I thought was very interesting from the poll. This is our slide 8, and this is the importance which the audience has attached to meeting compliance obligations. You'll remember it was second most important buying criteria after asset safety in my full list of 29. And here we see a lot more detail. We've got buyers of cryptocurrency services. They clearly want to avoid inadvertent compliance breaches in a field where the laws and the regulations, as we said at the outset, are becoming clearer, but they're still developing. And then you've got all these other long established obligations not to launder money, protect client data, and so on. These also apply in this new market. In fact, I think it's interesting to note from the poll how important post-trade services such as custody and compliance issues like AML and data protection are to buyers. Now, that's not immediately obvious from my list. So if we look at slide 9, and where we just count up the number of times a factor is named as important, it gives the impression trading services are much more important than post-trade or compliance. But that's only because we asked more questions about trading. So basically, trading factors get selected more often. If you adjust the data in slide, as I do in slide 10, albeit somewhat crudely, by simply dividing the number of mentions by the number of questions, we find actually that compliance is the most important factor by some margin, and post-trade is actually more important than trading. Stephanie, does that finding, when you're talking to clients, its emphasis on compliance and asset safety factors more important than trading factors, is this kind of what we should expect from regulated institutional money. In other words, they kind of expect you to deliver the trading piece, but what they're really going to judge you by is compliance and asset safety. Does that surprise you?
I said it wouldn't surprise me, but I think that they expect the compliance piece too. But although I mean, there's a long history of banks that have had AML findings over the years. When it comes to crypto, the bar is higher, right? And this is something we discussed in the pre-meeting around the panelists. It's not necessarily that it's a more risky space to go into, but it's just with the fact that you're going into a completely new asset class, with the sensitivity to some of the issues that they've had in the past, you can't afford to have a compliance issue in your crypto offering because of the way that might be that might impact you internally from your own second line functions and potentially from a regulatory relationship perspective. So it's just a risk that banks, they don't want to take it. They expect it, and it wouldn't be acceptable to have additional compliance risk in going into this new business area.
Carlos, did you want to add something to that? So, yeah, no?
For me, it's like if it's not compliant, they cannot offer it. I mean, it will not pass, let's say, the minimum suitability. The executive management will just back it off.
But how hard is it? How hard is it? How hard is it to be confident you're delivering compliant solutions, and when the laws and regulations are still evolving? And it's tougher
for
than
us,
in traditional markets.
you play on. Yeah, it's for us. It was a 3-layer, let's say, system: the internal layer, the external layer, and then the regulator layer. So for a bank, classically, it will be internal controlling and audit. Then the external, Big Four, whatever that you have, plus external law counsel, potentially, especially if you don't have a regulatory environment that is, let's say, clear. And then constant communication with the regulator on a one-on-one basis. And that can go from opening a sandbox for potentially exploring something to going into production, but confidently saying to the regulator, look, this is not on the scope of any regulation at this moment. This is how we plan to do it. This is why we think it's a good idea. And then the last word comes to the regulator, actually.
Okay, so keep talking to the regulators is the way to keep abreast of that risk that clients
especially
face.
at least if you want to be on the forefront.
Yeah, and when working with partners, doing a strong due diligence, and the first thing or the thing that we check the most with the LPs and the different partners in the space is their compliance procedures and their compliance team and how did they work, and you do a very deep dive into their compliance setup.
Okay, well, our time is almost up, so I'd like to draw our discussion to a close by looking at our final slide from the poll, which is the business model priorities when you're buying cryptocurrency services. We've established a few minutes ago that keeping the assets safe from the regulators and from the lawyers is as important as keeping the assets safe from criminals. But in the end, cryptocurrency services are still a commercial relationship. And our final slide here shows what registrants consider important in a service provider: a good reputation, full set of services, the option to buy only the services you need, and of course, something we touched on a few minutes ago, keeping the price keen. I was interested myself how the ability to white label the service isn't seen as particularly important. But this does add up to quite a complex package. What's become clear to me is that you've got these institutions who are seeking service providers that offer a full set of services. They want those services to be available on a modular basis. They want them priced competitively. They want their trades executed efficiently in market terms. They want access to multiple sources of liquidity across what a number of you have said is a very fragmented marketplace, one prey to all manner of criminals. And they want all that without compromising on the safety of the assets in custody or compliance with prevailing laws and regulations, even though those are still in a degree of flux. Now, that sounds to me quite a hard package to deliver. Stephanie, you're actually doing this. I mean, how hard is it to deliver this package, and I'm also quite interested in how hard the institutional clients find it to manage the complexities of this.
Yeah, no, absolutely. I mean, for us, it's a reason why we really focus on the larger banks in Europe that are launching offerings, because we need to make sure that we can be flexible where they're not, right? So that you have a clear offer and you can provide everything out of one hand, but you can also be flexible if they do the trading themselves, they have, they do the custody themselves, they want to trade with you as a broker, and they need flexibility in terms of settlement. So, I mean, it is a very difficult thing to do. And I think you either need to focus very clearly, and you do have players that only provide one part of the value chain, or you focus on client type, which is what we do, is really just focusing on the larger banks and brokers and partnering for the long term with them as aggregators.
Thanks, Stephanie. Let's just close our discussion with one final question to each of you. And Carlos, perhaps I could put this question to you first. Andreas has had to leave, but so we won't be hearing from him. But Carlos, the cryptocurrency markets are obviously well established now. They've been around for 15 years or something. The service providers that give ultimate market participants access to that market, that evolving market, also have to evolve in line with what's happening in the crypto markets and indeed what's happening in tokenized assets more generally. And right now, if you're a market participant, you actually have a lot of choice as to how you access that market. Do you think that choice is going to narrow over time? Are we going to see consolidation of service providers over the next, I don't know, 3 to 5 years? Do you think? I mean, it's a tough question to ask, Carlos, but I'd love you to speculate for our audience on that issue.
Thank you. So with MiCAR, we lost in Europe only 80% of fintechs offering crypto. So we went from on the thousands of providers targeting, offering end users access to crypto to the hundreds, centralized part. Then cryptocurrencies are evolving also, not only in tokenized, but also, the likes of hyperliquid, perpetuals, futures contracts, something hybrid in between. So I think to some degree it will consolidate, but not necessarily as the banking world has consolidated. I think we will have consolidation per country. I think that factor is more important than I thought. For example, this is something I missed in the last 2 years. I was, betting more on a consolidated European, set of top fours. What I see is consolidation per country in Europe, which comes back to the fact of saying it's a commoditized product offering. Thus, brand, local influence, and specifics are the most important factors, because to some point, or to some extent, infrastructure is harmonized now, and it's nearly commoditized. So yeah, my bet is consolidation. Yes, maybe per product, per country. Some specialists here, some specialists there, and then the local dominant plus the couple of followers.
Okay, so jurisdiction is going to continue to matter. Francisco, how do you expect trading, investing, safekeeping in the cryptocurrency industry to evolve over the next 3-5 years?
Yeah, I agree. I mean, on the one end, I think that, I totally agree with Carlos. On the fintech startup side, we will see some of the players moving out of the market due to MiCAR. They need to invest a huge amount of money to be compliant, basically, to build compliance and risk and legal teams that they didn't used to need in the past. So that's a huge burden. And if you have low volumes of low number of customers, that's a very high cost part of the structure of course that you need to compensate with revenue, and that's going to make it more difficult for them to survive. once the venture capital money dries out. No? So they have a run for some years with venture capital money, but up to a point they need to be on the green. So and that would be will be pushing out some of the players in the market. This is something that's happening with MiCAR, as Carlos said. We have seen it as well in Turkey with the new regulation in Turkey. Lots of the smaller fintech startups offering crypto services have disappeared totally from the market. On the other hand, we will see some new entrants coming in the market thanks to regulation again, which is the traditional financial institutions, the banks. Something clear in Europe, at least with MiCAR. We were one of the first to enter the market, but now in Spain, I think the top 5 banks in Spain and some other of the smaller ones have already MiCAR license, so they will start offering services in the space. No, so yeah, we will see a lot of startup fintechs moving out, but I am assuming the financial industry coming in as a whole. No, so we'll see those 2 movements in the following years in the different countries as soon as regulation is established in the different regions. No?
Mm-hmm. Okay, Stephanie, you've heard Carlos say that jurisdictions still matter. You've heard Francisco say that venture capital is starting to make choices now, and keeping going from funding round to funding round is no longer an option for some of the players in this market. What do you expect the cryptocurrency services market to look like in 3 or 5 years' time?
I must say, and especially because I'm conscious we're a little bit over, I think that Carlos and Francisco put it beautifully. And we can see the consolidation happening now. Börse Stuttgart and Tradias are merging, so we're in the middle of a merger process ourselves, which we're very excited about because trading and custody is a scale game, so it allows us to be a lot more competitive, and we continue to see that happening going forward.
Mm-hmm. Thank you, Stephanie. That is all we have time for, sadly, but we've had a comment here from a member of the audience saying, interesting insight. Probably what was not touched on was quality of assets. By which he means tokenized securities architecture. So we could have carried on for another hour, probably, but we must stop. I'd like to thank our panelists, Andreas Sack of Decker Bank, he's had to leave us already, Carlos Martin Doncel of Swissquote, Francisco Maroto of BBVA, and of course, our sponsor, Stephanie Hurry from Börse Stuttgart Digital. And thank you also to you, our audience, for taking the time to be with us on this day and in future viewings of our fascinating conversation this afternoon, and for all your questions and all your comments. Future of Finance, our next event is our annual Digital Money Conference, hosted by us here in London all day on 10th of June. I hope many of you will join us that day for an equally fascinating discussion with central bankers, as well as bankers and digital bankers, and not just about cryptocurrencies, but about stablecoins, CBDCs, and tokenized deposits as well. But with that, thank you very much. It's goodbye from the 4 of us. Goodbye.